Greetings and welcome to Elementary Accounting and Double Entry Bookkeeping. Just before we get started, remind everyone this is strictly for the entertainment educational purposes.
List B 2001 says, Oakland love time for some gum.
Oh, we're going way back. We're going way back before you're probably still running around diapers. Grandma was running around diapers. We're going way back. But before we do that, just remind everyone this is strictly for the educational entertainment purposes of this YouTube channel and program, not to be used, misconstrued, abused, or misused for anything legal, lawful, private, public, personal, tax, financial, or otherwise. So please don't do this at home. That said, let's get started. This is going to be an epic presentation here. And I call this one here, I guess it's the instructional guide to elementary accounting.
List B 2001 says, don't try this at home, laugh.
Definitely don't try this at home. This is something where one of those topics where, again, accounting is one of those things it's really not hard to do mathematically. In fact, it's just simple arithmetic. Yet somehow it eludes us in having mastery of it, where most people are reliant upon other people explaining all these accounting practices that affect our lives at every level. That said, it behooves us to go a little bit deeper into this. And before we do that, we're going to be taking a real deep dive tonight, and it's not going to take very long, and I'll show you why right now. Starting with the note from our author here of this text, which is from I think 1920, 29, 24, way back. Anyhow, what he's saying here, and this is from the eminent Joseph J. Klein. Should be an L there. Klein, PhD and CPA. While mechanical devices have made easier the task of bookkeeper, they have at the same time served to accentuate the need of a thorough understanding of the science of accounts. This is from the 1920s, and to say something like this, mechanical devices, we could just replace that with computers, AI, whatever it may be, have made easier the task of bookkeeper. They have at the same time served to accentuate the need of a thorough understanding of the science of accounts. The author, a number of years ago, acquired considerable experience in presenting the subject of bookkeeping to immature students as well as to adults. His experience led him irresistibly to the conclusion that the subject of bookkeeping may be so simplified that while retaining all its necessary comprehensiveness, it may nevertheless be imparted to willing minds within a period of time much shorter than that hitherto devoted to it in the school curriculum. So up until now, devoted to it in the school curriculum, it's been expected to take a lot of time. But we're going to see tonight it's only going to take one presentation to get through this here in the elementary accounting and the double entry bookkeeping. So we're going to use his experience and let him take us on this journey. And before we do, because this is from quite some time back, and indeed we are going to be using some terms that are still in use to this day, but I think it's something that makes this more difficult than it seems is the fact that most people have overlooked the hard definitions of some of these essential terms when it comes to accounting. A lot of people like to hold others accountable for their actions, but you can't hold them accountable without knowing accounting. So with that said, let's get on to some critical terms here, and let's start with the word account, as that's something that's really going to be resonating through this entire presentation. So account's a noun from the 14th century, means accounting. The principal filed an action for account against his agent. So this is the expression here, also spelled archaically account. So the action of account lies where one has received goods or money for another in a fiduciary capacity to ascertain and recover the balance due. So it's the action where one has received goods or money in a fiduciary capacity and to ascertain and recover the balance due. So to make sure you know the balance and then to recover it. It can only be maintained where there is such a relationship between the parties as to raise an obligation to account, and where the amount due is uncertain and unliquidated. So there it is. Let's move on down to definition 2, accounting. The contractor filed an action for accounting. Okay, so 3, a statement by which someone seeks to describe or explain an event. Keyword here, event. So Fred's account of the holdup differed significantly from Martha's, but this is not what we're talking about here. Let's see here. Well, either way, we're going to be going on through the different accounts, but that's what we need to know here is that an account here is basically accounting, and it's basically the action where one has received goods or money for another in a fiduciary capacity, and it's the account, hold them accountable to ascertain and to recover the balance due. And it can only be maintained when there's such a relationship. So by maintaining this relationship, we need to have some other common terms. Like one we hear quite common is bill. And bill is another word from the 14th century. It's a formal written complaint, such as a court paper requesting some specific action for reasons alleged. It's also an equitable pleading by which a claimant brings a claim in a court of equity, like a bill of complaint. So let's see here. Before the merger of law and equity, the bill in equity was analogous to a declaration in law. And here are the 9 parts of every equitable bill. The address to the person holding the Great Seal. That's for the Great Seal. The introduction, which identifies parties. 3, the premises, which state the plaintiff's case. 4, confederating part in which the defendants are charged with combination. Anyhow, we're not going to go through all 9 points here, but to see here where we're looking at bill, and let's see if there's a definition 2 down here. Quite a few bills here. Let's see here if we do get to a definition 2. Let's see here. No, I think this is it. So as we see here, it's basically a formal document or note, an instrument, a bill of sale. So here's where'd it go? All right, that was number 7. So let's see here. Where were we? 3, a legislative proposal, offer for debate. We missed 2. Bear with me here as we go through this here. It is a scanned document. And I got to look at both columns here now. Let's see, definition, or 2 was what we were reading here. Yes, okay, so we got 3. Now we need to get to 4. Here's 3 is a legislative. We know those bills in Congress and such. And now we got to get to definition 4. Should be over here. Left column, Oh, there we go. 4, an enacted statute is a bill, the GI Bill. An itemized list of charges, an invoice, like a hospital bill. So another definition for bill. See fee statement, which is different than the fee when we're referring to property. A lot of confusing words, and good to know this difference. So an enacted statute is a bill, but we're not done yet with bills because we got definition, missed 5. 4, 5, an itemized list. 6 is a bill of exchange. Here we go. These are our accounting terms here. A bill of exchange, a draft. The bank would not honor the unsigned bill. See draft. So like a check. So a bill of exchange. Notes, drafts, bills of exchange. Eligible papers for such. We also have a formal document or note, an instrument, a bill of sale. The expression bill of sale includes bills of sale, assignments, transfers. So the bill of sale could be a transfer, a declaration of trust without transfer. inventories of goods with receipts thereto attached, or receipts for purchase monies of goods and other assurances of personal chattels. We went over the property with personal chattels, and those are movable property, and it can be intangible too. Also, powers of attorneys, authorities, or licenses to take possession of personal chattels as security for any debt, and also any agreement, whether intended or not, to be followed by the execution of any other instrument. So we're still on the bills here, right? Bill of sale, by which a right and equity to any personal chattels or to any charge or security thereon shall be conferred. And that's principles of the law of personal property. Interesting. Bills of Sales Act of 1878 in the UK. A transfer may be either an absolute assignment by way of a gift or sale, or an assignment by way of mortgage or security only. But in either case, when a written document of any sort is used to effect the transfer, the document is technically called a bill of sale. So there it is, a formal document or note, an instrument. So let's keep that in mind when we say bill. It's a formal note or document. And I think we get 8, a piece of paper money, a $10 bill. 9, cleverly hidden here, a promissory note. And we're going to be coming into that within our presentation, so keep this in mind. A bill is a promissory note. So bills and notes. And let's see if we've made it to the end here. Bill of lading. Yep, I think we've made it to the end of bill, which takes us to our next word. We're going to be studying the subject of bookkeeping, and it makes us worthy of looking up the word bookkeeping here from the 17th century, the mechanical recording of debits and credits, or the summarizing of financial information, usually about a business enterprise. And specifically, we're going to be going over double entry bookkeeping. So starting with single entry bookkeeping, which is alphabetical, this should be first. A method of bookkeeping in which each transaction is recorded in a single record, such as a record of cash or credit accounts. This is the format that most people, especially with personal accounting, are familiar with. However, double entry bookkeeping is what we're going over tonight. It's a method of bookkeeping in which every transaction recorded by a business involves one or more debit entries and one or more credit entries. The debit entries must equal the credit entries for each transaction recorded. Key point there, that there's a balance here. And we're going to be getting over this. This is kind of just to get over the terms as we move along here. As we looked up word bookkeeping, well, they mentioned credits and debits. So what is a credit? Which takes us to credit. Let's see here, credit. Get a little bit further. I was getting lucky here. All right, give me a moment here. We're going to have to take some jumps. There we go. I just saw it. Well, I jumped right over it there, but here we go. There it is. Creditor. Credit from the 17th century. To believe. Interesting here. But that's the verb, credit. We need the noun. So credit, noun from 16th century. Belief. Trust. The jury gave credit to the Benson's version. We also have definition 2. One's ability to borrow money. Credit is the faith in one's ability to pay debts. A customer with good credit. We're getting there. 3. The time that a seller gives the buyer to make the payment that is due. 30 days credit. 4. The availability of funds either from a financial institution under a letter of credit, The bank extended a line of credit to the customer, which isn't what we're going for here yet. We are on definition 4. Definition 5, here's a letter of credit. This is kind of important here. Just mentions it. Okay, definition 6, a deduction from an amount due. Wow, an accounting entry reflecting an addition or to revenue or net worth. So what does this mean? We're going to be getting into that because that's what this is all about here. But think about that. Credit. This is letter of credit. It's what it's referring to as a credit when it's a letter of credit. But we're on definition 6 here is a deduction from an amount due. That's what a credit is. An accounting entry reflecting an addition to revenue or net worth. Confirm that the credit was properly applied to my account. We'll be getting into that. All right. So that moves us on to our next word since we did credit. Now we need to get to debit. All right. Let's see here. Debit from the 15th century. A sum charged as due or owing. So a debit is a sum charged as due or owing. In bookkeeping, an entry made on the left side of a ledger or account. We'll be getting into this in detail here. Noting an increase in assets or a decrease in liabilities. So a debit is an increase in assets or a decrease in liabilities. What you may owe. 3, an account balance showing that something remains due to the holder of the account. That's a debit. So think about this. It's a lot of strange ways, I guess you could say, that these have been used in a lot of contexts. But when you think about a debit card, right, it's a sum charged as due or owing. An account balance showing that something remains due to the holder of the account. So there's a balance showing. All right, so debit card is a card used to pay for purchases by electronic transfer from the purchaser's bank account. There we go. All right, let's move on to the next term here. We're going to be getting into some strange terms that get repeated over and over, and they're really super simple, like folio. So let's look up folio here. Interesting here. Let's see here. Didn't get me to where I wanted to go. Should have been there. All right, one more jump like this. We should be able to find it. Oh, all right, there we go. And if you haven't already, please hit the like so we can get more people in here because we will have a special surprise at the end of this presentation. So you definitely want to stay to the end. And here we go. We're on the O's. There we go. Folio, from the Latin, folium, leaf, 15th century. So think like foliage. Historically, it's a leaf of paper or parchment, numbered only on the front. But a folio includes both sides of the leaf, or 2 pages, with letters A and B, or R and V, signifying recto and verso, front and back here, right, left and right. Added to show which of the 2 pages was intended. Historically, a certain number of words in a legal document uses a method of measurement. So in England, 72 to 90 words. This is historical. 3, a page number on a printed book. This is the folio number. 4 is a large book, the pages of which are formed by folding a sheet of paper only once in the binding to form 2 leaves, making available 4 pages, both sides of each leaf. So you fold it in half, 2 sides of each half for 4 available pages. So that's all folio is. It refers to a page number. But they got to use fancy terms because it's accounting, and the whole point is to keep this inaccessible for common people. All right, let's move along to the next one, journal. another word that seems to be a barrier for most. So let's look at journal from the 15th century. It's a book or record kept, usually daily, as of the proceedings of a legislature or the events of a ship's voyage, also termed log, like a log book. See minutes. There you go. But what we're using it for is in accounting. In double entry bookkeeping, which we're going over tonight, a book in which the original entries are recorded before being transferred to a ledger. So there it is. It's a book. The journal is a book which original entries are recorded before being transferred to a ledger. So that means we need to figure out what ledger is. What is a ledger? All right, so let's see here. Here's ledger from the 16th century. It's a book or series of books used for recording financial transactions in the form of debits and credits, also termed general ledger. So there it is. We got ledger down. And that takes us to the end of this little trip down Black's Law so we can get back to our presentation. Thanks for indulging with me on that trip. Let's get started. All right, over here to get to the book. There we go. So, what is bookkeeping? Business, that is popularly understood, comprises the commercial activities of the community. Bookkeeping consists of recording the financial doings or acts of businessmen. 1924, so simple illustrations of transactions are buying, selling, paying a debt, paying wages, etc. An elementary knowledge of arithmetic is all that is necessary to comprehend the subject. The bookkeeper's mission is to record every transaction so that at any moment the owner can learn how much money the business has, how much it owes and is owed, whether it is operating at a profit or a loss, and what the business is presently worth. So we're going to be going over all these things here: the cash account, double entry, expense of proprietor, trial balance, customers or creditors, but I'll leave it to the presentation to reveal. So let's go to part one, the cash account. Receipts on the left, payments on the right. The simplest possible record. So let's see what we're most familiar with here. From diary to ledger, how bookkeeping begins. So to show this, how this simple bookkeeping can be, consider this record taken from a boy's diary in May 1924. So on May 19th, his father gave me as a birthday gift $1. Pretty good 1924, remember. On May 16th, received from mother and Uncle Tom 75 cents. Then on May 16th, he bought a pair of skates, and that was 80 cents. On May 16th, he paid 50 cents to see the baseball game, so he spent 50 cents. On May 17th, he earned 25 cents, delivering a package. So there goes into received. May 17th, sold my skates to Bob Summer. 65 cents received. On May 19th, he bought a box kite. 35 cents spent. So the total for the received column was 265. The total for the spent column was 165. So you subtract simple arithmetic, you end up with the balance on hand of $1. This is the boy's diary. Every receipt and expenditure is required. So the bookkeeper arranges these same figures on specially ruled paper, a cash account. The key insight: receipts are always grouped in one column, payments in another. This grouping is not arbitrary. It is the foundation of the entire accounting system. The bookkeeper calls the receipt column the debit side and the payment column the credit side. All right, let's break this down now. The cash account, debit left, credit right. The bookkeeper's version of the diary employs specially ruled paper. Here's how the June transactions are arranged. And what we're using here is a little T table, as they may call it. And again, we're going into the traditional ways of doing this from the 1920s. This is about the time when the importance of paper really came into the financial realm, and why accounting and bookkeeping of this nature became essential. So let's look at it from these perspectives. What we have here is cash. So this is the cash account. So the account name's at the top. We have two columns, left and the right. Left is debit, and of course they have to make it complicated, so it's abbreviated DR, but it means debit. Even though there's no R in debit, it's DR. And credit. And I think this has to do with the R and the V or whatever it was there for those abbreviations we were reading for folios and such. Nonetheless, DR is for debit, CR is for credit. I just want to make sure that is ingrained in our heads because we're going to be seeing it a lot. As it says here, cash account receipts, DR on the left, payments, CR on the right, debits, receipts, credits, payments. So on June 1, sold apples for $80. June 3rd, sold apples for $80. June 7th, sold potatoes for $80. And on June 10th, sold potatoes for another $80. But on June 4th, on the credit column, the payments, you bought potatoes for $80. And on June 8th, you paid the clerk's salary, which was $80. So the balance here was $80. I think there's a double entry over here. Nonetheless, let's see here. The bookkeeper states two fundamental rules of the cash account. Rule 1A, debit cash whenever the business receives money. Rule 2A, credit cash whenever the business pays money. The balance is always a debit balance. We cannot spend more than we have. The excess of the debit side over the credit side is the cash on hand at any moment. Note, debit and left hand are synonymous. Credit and right hand are synonymous. So whenever we say the left hand column, it's always the debit.
Clicks the memo that says remember to fill up your gas tank ASAP.
Yeah, I hope everyone did yesterday. Nonetheless, if you haven't, good time after this presentation to go fill up your tank. Although I don't recommend doing it in wee hours like this for most time zones, but nonetheless, it's probably better than standing in line. I digress. I think I have an error here. There should only be, their balance is 80. Anyways, let's just take one of these out, and then the balance will be 80. All right, let's move along. Now let's look at the motion picture device, how to analyze any transaction. We're back in the 1920s. So motion pictures were kind of a new thing, and having that imagery of seeing that perspective, that third person perspective, so to speak, of a transaction is what these authors referring to here, and using it as the analogy of viewing a motion picture. So let's look at this here. The author offers a device that has proved very valuable in teaching bookkeeping. If you can picture or visualize what transpired in a given transaction, if you really see the receiving and giving, the solution is practically determined. Imagine you're viewing the transaction on a motion picture screen. So look at this, transaction 1. February 1st, sold 10 barrels of flour at $8 for cash. $8 a barrel. So 10 times 8, that's 80. So what we received, money, cash money. What we gave, goods in the form of the merchandise. We sold 10 barrels of flour. So debit the cash, credit the merchandise accounts. So transaction 2, follow me here, February 1st. Bought 10 barrels of flour at $7 a barrel for cash. So what we received, goods, merchandise. What we gave, money, cash, $70. So what we do is we debit the merchandise account and we credit the cash account. Making sense yet? Let's look at the resulting accounts. So on the cash account, we have a debit, the sale of flour, $80. So that was over here on February 1st. And we also have a credit, the purchase of flour, which was from this transaction here. And that's where we credited the cash. Why? Because we had to buy 10 barrels of flour at $7. That's $70. So that goes on to the credit. As we see here, we credit the cash account. So on the cash account, we added $80. We received it when we sold our 10 barrels, but we had to purchase another 10 barrels, and that was a credit from the cash account. Is it confusing yet? I hope not, but if it is, it won't be very long, because let's continue here. Now on the merchandise account, as we see here, we have two accounts. We have a cash account and merchandise we're looking at. On the merchandise account, from this transaction, these two transactions we just saw here, right? We're debiting the purchase of the flour. What does that mean? That means that we got flour and we have to add it to the merchandise because we paid it. But we had a credit here, the sale of flour, $80. So that's something where we had to get this $80, right? That's the credit. That's going to be the credit on the merchandise here from when we sold the flour. So in other words, we sold flour, $80 of flour left our merchandise. And this is what brings it all together, is once we get these monetary values in for these different accounts. Even though it's merchandise, that merchandise has a value. Now, could this change over time? This price could. And that means that this value only changes to that when we credit it. Okay, so again, when it was debited, when we debited merchandise, when we bought flour at a particular price, that's the price we bought it at. That's the price it's going to be here. But we don't know what it's going to be credited at until we sell it. If that helps make sense, because while it's sitting there in merchandise and inventory, that's there's still a variable that's yet to be determined. What's the rate it's going to be sold at? But I'm getting ahead of myself. Let's move along to part 2, the double entry bookkeeping. Every transaction is an exchange of equal value. The record must show both sides. So this is the essence here of double entry bookkeeping and why one account is not enough. Throughout the economic world, there exists an equivalence of exchanges. If we buy shoes for $5, we part with the money, but receive an equivalent value. If we sell a book, we give a book and receive money. If we employ a clerk, we obtain services and give money. The cash account records money received and money spent, but it fails to account for the sources of the receipts and the causes for the disbursements. So here's our problem. So on February 1st, we sold 10 barrels of flour for cash. The cash account is debited for the money received, but where's the record that we parted with flour? The cash account shows the receipt, but not the cause. The solution? We open a second account, the merchandise account, to record what we gave. We debit cash, we receive money, credit merchandise, we have goods. Now the record is complete. Both sides of the exchange are captured. So here's the 4 master rules of double entry. From these observations, we derive the 4 conclusions that govern every transaction in every business on earth. Rule 1A. Debit cash account whenever the business receives money. You get that? Debit the cash account whenever the business receives money. Rule 2A. Credit the cash account whenever the business gives money. So you debit when the business receives, you credit when the business gives money. Then there's rule 1B. At the same time, credit another account for the same amount. So whenever you debit cash, whenever businesses receive money at the same time, you credit another account for the same amount. And rule 2B, same thing, when you credit the cash account when you pay out money. At the same time, debit another account for the same amount. The fundamental principle of double entry is every transaction must result in debits and credits of equal amount. We call our subject double entry bookkeeping because every transaction is recorded twice, once as a debit and once as a credit of exactly equal amount. This is not a convention, but a reflection of economic reality. Every exchange has two sides. All right, let's get on to the expense account. That not all spending is on goods to be resold. Services and consumables form a separate class. You see here, I'm sure there's questions. This is how we're going to answer them here with the 3 types of business spending. When a business spends money, it's not always buying goods to sell again. And consider these 4 March transactions. March 1st bought 10 barrels of apples for cash. Received apples to sell, goods to sell. The account is merchandise. March 2nd, books and stationery for office use. You receive supplies to consume. That goes into the expense account. On March 3rd, you get postage stamps. Stamps, which are for service or to consume. Again, the expense account. And March 4th, paid rent of the store for the month. So that's for the use of premises. Again, an expense, a consumable. So key distinctions here: goods bought to be sold again are considered merchandise accounts. Goods bought to be consumed, supplies, stamps, etc., go to the expense account, and services acquired, rent, labor, telephone, go into the expense account. So expense accounts and merchandise accounts. And let's look at these 3 accounts. Of course, we already went over the cash account. So here's how all 4 March transactions appear after posting to the 3 active accounts. Cash is credited for every outflow. The offset reveals what was received. Okay, so this is all about the spending part here, right? So remember, we bought apples for merchandise for $200, and we also bought stationery for $40, stamps for $15, and rent for $120. Good rent back in the 20s, huh? 1920s. All right, so on the cash account, we can see where all these debits, which were received apples, we received stationery, we received stamps, we received rent, and all the money for them. So for each of these, we see here on the merchandise account, March 1st, $200. Merchandise, $200. March 1st, March 1st. Then we have March 2nd, an expense of $40. March 2nd, stationery, $40 in the expense. We don't need to put stationery because we'll see why later. We're referring to the expense account on March 2nd. Then on March 3rd, we have $15 for an expense. What was that? The stamps. And March 4th, we had another expense of $120, and that was that very good rent for the business. So here's our notice. Cash is credited 4 times, once for each payment. The 3 accounts together tell the complete story. So from looking at this, referring to these 2, we get to see the full story of what we're spending our money on. The expense account accumulates all losses that are not connected with buying and selling merchandise. Its debit balance at the end of a period represents the total cost of operating the business. It is a loss account. It always has a debit balance. So there it is, the 3 accounts. And now we get to part 4, the proprietor's account. The owner invests in the business. The business owes him a claim. The claim is the proprietor's account. So let's see this account here. Opening the books. S.S. Luke begins business. So on June 1st, S.S. Luke began the flour and grain business by investing cash, $5,000. The business received money, so cash must be debited. In return, it gave S.S. Luke a legal claim against itself, so his investment account must be credited. Look at this. The entry, debit, they received, right? A debit, they received cash, 500. Credit, they owe S.S. Luke the investment of $5,000. So let's look at this. In the cash account, they received the debit. This is the left column where the receipts go, $5,000. But now we have an account here. We open an account for S.S. Luke Investment, the proprietor's account. So why credit the proprietor's account now that we have the proprietor's account and it shows that we owe to this account $5,000? It's because the business gave him a legal claim against itself, a recognition that his money belongs to him and must one day be returned. This is the founding entry of a business. Every subsequent transaction will be measured against this original investment. Debit equals received. Credit equals given. The same rule that governs every account in the ledger. All right, so let that sink in. As we move to the next slide, 4 transactions building the proprietor's account. So let's look at this here. His investments. S.S. Luke. He makes an additional investment of $2,000 on July 1st, then withdraws $500 in cash, and takes $200 worth of goods for personal use on July 8th. Applying the motion picture device. So we're viewing this on a motion picture screen, a movie screen. July 1st, additional cash investment. So the business received money. Debit cash, right? We receive cash. Business must give a claim to credit S.S. Luke for him giving us this $2,000 in cash. Let's move along to July 5th. S.S. Luke, the proprietor, decides he needs to withdraw some cash. So the business gave money. So we have to credit the cash account. Cash came out of the credit account, gave something. We have to credit that on the cash account on the right side. The business received back part of his claim. The debit owed S.S. Luke. The debit went to S.S. Luke, so he gets debited, which removes part of that claim he has on the credit side. So on July 8th, proprietor takes goods for personal use. So the business gave goods. It means we put a credit on the merchandise account. The business received back part of the claim, so we get to debit the S.S. Luke account for that. So we see here how this whole narrative worked. We watched it. So imagine these transactions. Proprietor comes in there and says, "Hey, I'm going to take some of this flour home, make some of my bread." All right. So on July 5th, cash withdrawal, $500. So from the investment over here, they receive part of that liability back. Right, on his investment account. And on July 1st, remember that on June 1st, that was the original investment of $5,000. On July 1st, a month later, he gave the additional investment of $2,000. July 5th, he decided to withdraw $500. On July 8th, he took home a bunch of that merchandise, $200 worth, right? So these are both removing the liabilities from this side. So parts of it. So again here, let's look at this analysis. Proprietor's account. The original investment, $5,000. Additional investment, $2,000. Total invested, $7,000. Less withdrawals, $700. So the net investment now is $6,300. That's the claim against the business that the proprietor has. So as we move along, the universal rule. Debit and credit for all accounts. So from the preceding sections, we can now state the general rule that applies to every account in the ledger, without exception. So the rule for debiting. Appropriate accounts are debited whenever money, goods, claims, or services are received by the business. Rule for crediting. Appropriate accounts, so the right account, are credited whenever money, goods, or claims are given by the business. So you give a claim to your business saying that you're willing to pay something or terms or whatever it may be, claims, money, and goods. Anytime the business gives them, that's considered crediting. So the business offers you a credit. They're giving you something, right? All right, so look at the accounts. Cash account is debited whenever the business receives money and is credited whenever the business pays money. The merchandise account is debited whenever the business receives goods. It's credited whenever the business sells or gives goods, like when they gave goods to the proprietor. The expense account for services or supplies received, it's debited. But whenever there's refund received, which is rare, it's credited. So expense accounts usually are always something where they are received and then consumed. So there's no nothing given back here. So received refund receives are rare when it comes to expense accounts. Uh, yeah, I've never seen anyone really refund anything from an expense account. I'm just trying to think of an example. I can't. Usually people try to max out expense accounts, but that's another topic. All right, so proprietor account is debited whenever the owner's claim is reduced, withdrawals, right, or any kind of draws that they may make. It's debited. Okay, something's received from the business. They're relieved of part of their claim, right? Uh, and then credited whenever the owner's claim is created, the investment. So whenever they're given money into the proprietor account, it has to be credited for the owner's claim for that money of investment that's debited there. Okay, we're on to part 5, the trial balance of totals. Sums of equal are equal, proving that every transaction was entered correctly. So we're getting a little bit of auditing here. And for those of you that have just arrived, definitely remember to fill up your gas tank. Don't do this at home. And most of all, please hit the like. And I believe we do have the talking chat enabled here just to make sure.
The tribe says, hit the like.
Yes, indeed. So if you have any comments, questions, or clarifications, feel free to pipe up in the chat and I'll read it back and we can address it as we go along and keep the presentation interactive. And definitely stay to the end because we have a very special surprise coming at the end. First, let's go over why debits always equal credits. The axiom proved. Once all transactions have been posted, the bookkeeper lists the total of the debit side and credit side of each account on a single sheet of paper or spreadsheet. The result is called the trial balance of totals. Observe that the sum of all debit totals equals exactly the sum of all credit totals. So let's look at this. Why must this be so? Because every single transaction resulted in debits and credits of equal amount. The sum of all transactions therefore produces equal totals. So let's look at this here. And I'm sure there's going to be some questions. Feel free to pipe up, but we're going to be answering all those questions shortly. But just for this overall view here, and look at this axiom here. The account here of SS Luke proprietor. The debit total was 800. The credit total was 7,000. So on his account, the business owes him 7,000. We've given him 800 so far. Okay, that's what he's taken in goods in that draw of $500. So on this account, he's received 800 and he's given 7,000. That's in this account. In our cash account, we've received 7,000, the left side, and we paid out 1,100. What did we paid out that 1,100 with? Well, there was the merchandise, $400 of merchandise. was received, but 300 given, and the expenses for 200 that were just that was just gone. So that's from that account. So we look at our debit total here, and we add up these sides. We have 8,400 on the credit side, 8,400. So as we see here, everything adds up. Everything received into each account and everything that has been given from each account. And it shows a balance. We talk about balancing the sheet or balancing the transactions here. This is what we're talking about. So what the trial balance tells us. Trial balance is considered proof that the bookkeeper has entered debits and credits of equal amount for each transaction. It will not detect every error. Example given, a wrong account debited with the correct amount will still balance. But it is the essential first test of the ledger's internal consistency. So, again, there can be clerical mistakes, as they call them, but assuming that there's no clerical mistakes, this right here is proving by balancing that all the entries were done properly. So if there was an improper entry, you do the trial balance, say, okay, something's missing, something was not entered correctly, go back to the books, find out where it was, and come back, do the trial balance again until they equal up evenly like this. So again, we see here, Luke, the proprietor, he received $800. He received $500 draw, 200 in merchandise, but he total gave us 7,000 that we owe him. So we owed him 700. He got 800 back. And the cash shows we have the 700, right? But we paid out a lot. We paid 800 plus 400, and the 200 for expense. So I guess this all adds up here. Let's see here. Yeah, it's 1,100. 300 for the merchandise. This is a merchandise that was purchased and the merchandise that was given to proprietor. Let's look at that merchandise one again. I forget those exact numbers. Let me make sure I had this correct in here too. It was back one more. Okay, there we go. All right, so we have here that he took 200, yeah, and 500, so 700 personal use. And then the original investment, additional, total invested, and then we also had, where'd it go here? All right, well, that was way back there. Never mind. Let's just continue on here. Any questions, anything else that we need to clarify, just let me know. We can always go back, but I'm not going to spend any more time on that. We're going to move ahead here. As you can see here how it balances out. That all the expenses, the only expense here was the consumables. Again, no credits on that side. This is always going to be something that goes into the expense account. It always receives those funds and it comes out of cash. So, all right, let's move along. Time transactions and customers. So selling on account. The customer receives goods now and pays later. We hold a legal claim against him. Same thing like with the proprietor. He gave us money to invest and he has a legal claim against the business. Cash sale versus sale on account, the key difference. Thus far, all purchases and sales involved cash, changing hands immediately. Business reality requires that we sell goods to trustworthy customers on credit, on account, or on time. What changes in our accounting? So let's look at this. On the cash sale, March 1st, we sold T. Brown 10 barrels of flour for cash. So here we go. On the debit side, the DR and the CR for credit side, of course. Left side received, credit right side gave. March 1st, we received $500. because on the merchandise account, we gave $500, credit of $500. We credit $500. We sold the 10 barrels of flour. We received cash, went right into the cash account. All right, let's look at this sale on account now. March 3rd. So F Green has an account. We sold F Green 10 barrels of flour on account, not for cash. The motion picture shows we gave merchandise but received a legal claim against F Green. We didn't see money get exchanged like with T Brown. Here we received a legal claim against F Green. We must record his indebtedness until he pays us. So how do we do this? Well, F Green has an account now. We sold him 10 barrels on account. So his account received $500. And our merchandise, we gave $500. So we need to get, this is something that we gave. This needs to get balanced out. Let's move along. Oh, as we see down here, debit cash, credit merchandise. All right. So let's look at the, are we on the right slide here? Yep, indeed. So let's look at the T Brown customer account, building it step by step. So we sold T Brown $500 worth of flour on March 1st on account. Another $400 worth on March 8th. And on March 10th, he paid us $300 in cash as a partial payment. Whew. So let's look at the motion picture device to give us exactly what to do at each step. Should probably say the motion picture analogy, but we're in 1920s terminology. So let's look here, or I should say vernacular. So for the date in this column, we have the account and the explanation in the next column. The LF stands for ledger folio or ledger page number. Let's say it down there. Okay. But that's what that stands for. Ledger folio. So the ledger page. This would be journal page 1. They're all on journal page 1. And then we have the debit column here, the left, and the credit on the right. So let's look at this customer account. This is the customer account. On the first, we have T Brown, debit $500. He received $500. What did he receive? He received merchandise because there's a credit on the merchandise. We credited him. He got this, and now it's over here on the credit. We sold on account 10 barrels of flour. So we gave him 500. His account receives 500. On March 8th, T Brown on J1 receives another $400 of merchandise credited from our merchandise account. So how did this get here into his account? This debit, he received $400 into his account, which he's going to have to be liable for. It's a claim against him. We put money in his account. There's a claim now for that $400. And where did it come from? It came from our merchandise. So it's out of our merchandise account. Sold on account. Additional goods. Now, on March 10th, T Brown came to us with $300 cash. So onto the cash account. We get on the cash account, we receive $300. But where's that $300 go? It gets put into the credit for T Brown. So from what we've been giving him, now he's gave to us. So from his account, $300 onto the credit. So received on his account, T Brown. So where we go from here, here's T Brown's account. March 1st, merchandise. March 8th, merchandise. On March 10th, the credit, the partial of 300. See how this goes? So he's received 900 of merchandise, but he gave us only 300 in our business. So the account analysis, the account shows that T Brown bought $500 in March 1st. He bought $400 on March 8th, but then he paid $300 on March 10th. How much does he still owe us? Well, if he started with 900, he gave us 3, he owes us 6. Very simple arithmetic. Credit balance of any personal account indicates a creditor. So this is the easiest way to tell if it's a creditor. Debit balance indicates a customer debit. So the credit balance of any account indicates a creditor, like the proprietor, and the debit balance indicates a customer debtor. Okay? The debit balance, here's more on the debit. It hasn't been balanced with the credit side yet. Then just by a glance, you know that T Brown is a customer account, not a proprietor. You see how that works? All right, let's move along to part 7, the time transactions and creditor. So buying on account. We read this already, didn't we? Now let's look at the L. Martin creditor account, purchases on account. So April 1st, bought of L. Martin on account 100 barrels of beef at $800. On April 5th, we bought of Sable Company on account 25 barrels of apples, $300. So in each case, merchandise was received, so merchandise account must be debited. We did not immediately give cash. Instead, we owe L. Martin and Sable Company. They are our creditors. They hold claim against us. So let's look how we do this here. On April 1st, merchandise was received of $800. L. Martin gave, there's credit of $800, and that was for, we bought 100 barrels of beef. So for the L. Martin account, he gave $800. He has to receive $800 at some point. But then on April 5th, merchandise, and this is of course the ledger folio was recorded in the journal entry, page 2. Journal page, all these are on journal page 2. So the last ones are on page 1. But this is just to show you where that reference column would be. It's not really relevant to this. Let's move along here. So on April 5th, back to merchandise, we purchased more stuff. We bought 25 barrels of apples from the Sable Company. So with that merchandise, those 25 barrels of apples, we paid $300 for, right? So we received in the merchandise $300 worth of merchandise, but it didn't come at no cost. Sable Company has a claim. We have an account showing that we owe them $300 because they gave us $300 of merchandise. Then on April 12th, L. Martin, they gave cash. They paid us cash, and they paid on the account. So, I'm sorry, no, L. Martin is, I'm on the wrong one here. L. Martin's the guy that gave us the 100 barrels of beef. So we owe him $800, but we paid $300. So we credit $300 out of his account. So paid on account. So that's on the L. Martin account. It receives $300. So again, he had credited us over here $800. We had gotten $800 of merchandise, but now we're going to be able to credit $300 to his account. But we still owe him $500. So let's look at this over here. The L. Martin account, April 12th, the cash partial payment $300. Cash balance is $500. So we still owe him $500 out of that $800 because originally he gave us $800 of merchandise on credit. See why we say it's credit? It's in the credit column here of his account that he gave us $800 of merchandise on credit. And we have here on April 12th a partial payment, $300, and then April 30th, just that's the date they're doing the books, $500 is the balance. As you see here, because there's a cash balance, then this is a customer here, right? L. Martin paid, or not a customer, this is a creditor here. Martin paid balance $500 in cash. Wait, which one's Martin? Oh, L. Martin was paid the balance of $500 in cash. Account closed. Okay, sorry, I read this wrong here. He gave us $800 on April 12th, as we saw here. The $300 was paid, but that we didn't have the April 30th. The April 30th was the next entry, and that's when we paid him the rest. So we gave him the partial payment on April 12th, and the rest, the balance that was due, the $500, we paid him And that's why it's in this column here of the Martin account. Now let's look at the Sable account. They gave us $300 of apples, and that went into merchandise in the Sable account. But we still haven't put that money back in. We haven't finished paying their balance. They're still at the full 300. That's the credit balance. The credit balance of any personal account tells us we owe that party money. A debit balance tells us they owe us. So in this case here, we owe both these characters money. And we're on to customer or creditor, reading the dates. So this is essential here for the dates to be able to tell us. A personal account without dates can be ambiguous. The dates reveal the story. Consider the account of Peter Jones. So here's example 1. You can't tell. It just says a debit of 200, credit for 300. Credit for 200. This could be a debtor or creditor. We have no idea. John Cooper is, because it's already balanced out here. Then example 2, the customer is debtor. Debted first, bought before paying. So if May 1st was when things were received, right, by the account. So John Cooper received $200 of something on May 1st. And on May 15th, John Cooper gave us back the $200 of value. Then that means that he's a customer. He was debited first before paying. Then example 3, the creditor, we owe. So here's Peter Jones. On August 7th, there are 3 payments totaling $800. But back on July 3rd, so the creditor is the one we owe. So we gave these 3 payments, 500, 200, and 300. So there it is. These are on those 3 dates on August 7th. So he was paying these. Let's see. So he paid these 3 payments.
Debonair says, thank you. This is a very important topic. Have you visited Form 56 and Form 2848?
Greetings and welcome to Divine Rights. No, I haven't visited those yet, but I sure will now to get that. Gotta put that down. So indeed, the what we see here, that Peter Jones made 3 payments, and now we owe. So 3 payments totaling $800. So these were things that let's see here. He paid us. So we owe him. He gave us these 3 payments. Now we owe him $800 here. So we received that. He paid us that, and then on August 7th, 3 payments totaling $800. This is kind of unclear here. Again, these are just little T tables to give examples, and it's confusing me just looking at this stuff here. So again, we see here the creditor is where we owe, and that's where, of course, you see the dates here are telling that story. So a personal account shows the party as a customer debtor if debits come before credits. If credits come first, the party is a creditor. We owe them. So there it is. The credits came first. They were paying these payments to us, and August 7th, we made good on those payments. We gave them the exchange there. All right. Schedules of customers and creditors. When a business has many personal accounts, the bookkeeper prepares a schedule, a dated list of every customer and creditor with a balance each owes or is owed. Schedules are derived directly from the personal ledger accounts. We've heard this a lot, schedules. So, schedule of customers, accounts receivable, April 30th. So we have the customer and the balance owed to us. T. Brown owes us 600. F. Green owes us 500. The totals receivable, 1100. Then we have the schedule of creditors. This is accounts payable, April 30th. We have the creditor and the balance we owe. L. Martin, 0. We've already paid him. Sable Company, we owe him 300. In New York Trading, we owe them 400. So the total payable is 700. This is the balance we owe now, totally. And this is the accounts receivable. This is the amount that we are owed. Schedules prove the ledger. The total receivables must equal the sum of all customer account debit balances. Total payable must equal the sum of all creditor account credit balances. If they do not agree, an error exists in the personal ledger. Now you see how the accounting gets a little bit more complicated, but the math is simple. It's just a matter of keeping these ledgers organized. Personal accounts serve a dual function. They are individual histories of each business relationship, and in aggregate, they provide the receivables and payables figures that appear on the statement of assets and liabilities. So, starting to see how easy it can be to cook books when you know how everything's working behind the scenes and how to balance them out, but then a good auditor can also sniff it out. From mental analysis to formal journal entry. When analyzing a transaction mentally, the student decided on debits and credits and entered them directly into T accounts. In practice, the bookkeeper first records every transaction in chronological order in the journal and only later posts the entries into the ledger accounts. So they first go into a journal and then they go into the proper ledger accounts. The journal is the book of original entry, the first permanent record of every transaction. It serves two purposes. One, preserving transactions in date order with full explanations. And two, acting as an indicator, showing which accounts to debit and credit. So let's look at some journal page observations and the 4 formal rules. 1. The dates are written in the middle of the page, occupying a line between entries. The month and the year usually appear but once on each page. Now, this is going back to the 1920s. Most of these conventions have been updated. Nevertheless, just to see the principles that still apply, just different styles and approaches to accomplishing the same ends. Each account to be debited is written close to the vertical lines with the amount in the first left money column. Accounts to be credited are written beneath the debited items, indented about 1/2 inch to the right with the amount in the second right money column, and every entry must be self-explanatory. The bookkeeper tests each explanation for completeness, clarity, and conciseness. A full journal page. Here's the first 3 entries. Whew. So S.S. Luke began the flour and grain business on June 1st. Remember, with that $5,000 investment. Here are the first 3 journal entries. June 1st, cash. That's ledger folio is in page 1 of LF. So it's a ledger. Which one is it in? LF numbers are filed at the time of posting. Okay. So at the time of posting, these will be filled in the proper ledger. But this is our journal. So let's start out with June 1st, cash. That was the cash received. $5,000 received in the left column. And that's from S.S. Luke, the proprietor. And detail here, the investment of cash in the business. So we have all the explanations here, all the parties, the amounts, what type of transaction, debit, $5,000 cash. And on the Luke account, the proprietor account, is a claim against a business for $5,000. They gave $5,000, we received it. All right? So it went from proprietor account to the cash. Now on June 2nd, there was merchandise. So we received some merchandise. We had to pay cash for it, $400. What was that merchandise? It was merchandise for sale. That was barrels of apples for cash. So we paid cash, we received barrels of apples, and it's even detailed here. And then we have the expense on June 4th. That was $200 cash spent And of course, that paid rent and the sundry expense. So that's at $200 there. $80 for expenses and $120 for rent. Those are considered consumables, not merchandise for these purposes. And that's at $200. Of course, nothing received there. That was cash taken out. The only thing that was received was the expenses of the rent and the sundries, which were consumed. So the consumables. Uh, that account just goes away. Again, there's nothing really gets credited on this one. Cash was credited because cash gave for the expendables. All right, June 1st debits cash, the received money, and credits the proprietor's account. The business gave a claim against itself. The LF numbers are filed at the time of posting. And let's continue on the next slide. So let's look at entries 4 and 5. So the next two entries introduce purchases on account and sales on account. So on June 6th, the merchandise account, and ledger page 3, $800 received in merchandise from L. Martin. What was it? It was 100 barrels. We bought 100 barrels of beef on account. So now there's a credit. We owe L. Martin on his account. There's a claim against us for $800. On June 8th, on the T. Brown account, we also have received $500 of merchandise. But that's the T. Brown. Okay, here we go. The T. Brown account receives $500. So we got it on his account, $500 of flour. It came from merchandise. We gave merchandise. His account received 500. We have a claim on his account now for that 10 barrels of flour. There's 5 complete entries for the period we looked at. Each entry names the accounts debited and credited, states the amount, and records a full explanation. The ledger folio column remains blank until posting, but we threw in some numbers here anyways just to see what it would look like. Let's move along. So part 9, posting, the bridge from journal to ledger. Journalizing alone is incomplete. The entries must be transferred to the ledger accounts they affect. That's where that page number, the ledger folio, the page. So how posting creates the audit trail. The act of transferring journal entries to ledger accounts is called posting. As each item is posted, 2 cross references are written. The ledger page goes in the journal's LF column, and the journal's page number goes in the ledger account. So it's already in the journal. The LF column is empty. We put it into the ledger account now. Now in the ledger account, we could put the journal number in there. But let's look at this real quick here. We have on date from the journal here, account explanation, cash. That's ledger folio too. Well, we don't worry about this yet, but we see a debit of $5,000 from the proprietor. That's what we received. And on his account, a credit of $5,000. He has a claim against us because he gave $5,000. And what's the detail? An investment of cash. So 1 transaction, 2 entries. You see here? All right, so let's look at these 2 entries here. We have SS Luke, ledger page 1. Okay, this is where we have the credit. And it comes from page J1, journal page 1, on June 1st, $5,000 that he gave us. On the cash, this is the $5,000 he received. Same thing, recorded on journal page 1 on June 1st. So you see these 2 ledgers, SS Luke ledger and the cash account ledger. There we go, and the page number of these in the investment cash. So let's move along here. J1 in the ledger means this item came from journal page 1. The 2 in the journal means this item was posted to ledger page 2. The system creates a complete audit trail. Any question about any entry can be traced. Journal, ledger, follow the LF number. Ledger to journal, follow the J1 reference. A trial of balance totals taken after posting. Once this has all been posted, proves that all postings maintain the equality of debits and credits. If the trial balance does not balance, the bookkeeper knows an error exists and must locate it before proceeding. So there it is, the audit trail to help. Now we're on to the journal, concluded. With posting mastered, we move from scaffold T account analysis to direct journalizing and the full bookkeeping workflow. We're almost there. So from analysis to fluency, the complete workflow. So the source document, invoice, receipt, or bill of sale, as we went over earlier. Journal, chronological record of entry. And the ledger, the classified account for each category. Then the trial balance, arithmetic proof, debits equal credits, and the financial statements, profit and loss and balance sheet for a period. At the fluency stage, a student journalizes a complete set of transactions, posts each to the ledger, and takes a trial balance. Here's a trial balance drawn from SS Luke's illustrative transactions. Here's the account, debit total, credit total. SS Luke proprietor gave us $5,000 and credited $5,000. Cash, debited or received $5,000, credited $600 here. This was, let's see here, gave out $600. Merchandise, received $1,200, $500 was given out. Expenses, $200 of expenses were received. L. Martin, he gave us $800, we owe him. T. Brown, he owes us $500. So the totals equal out. $6,900 here, $6,900 there. Trial of balance totals, SS Luke's business. Debits and credits both equal $6,900. We're all good. So let's look at note transactions. Ooh, this is where it gets fun. A promissory note is a written promise to pay. Notes receivable or notes payable. Which are we to pay? So notes receivable is when a customer gives us his note. His note. On June 6th, sold R. Brown 100 barrels of flour on his 10-day note. That's a promissory note saying in 10 days he promises to pay. We gave merchandise and received a written promise to pay. The motion picture shows received a note, a debit, notes receivable, gave goods, credit, merchandise. So we have a notes receivable account. Here's our date, account explanation, ledger folio, debit and credit columns. So June 6th, notes receivable. We received $900, a promise to pay, and we gave $900 of merchandise and sold on his 10-day note, 10 barrels. Then we have on June 16th, cash, notes receivable. So we received $900 in cash, and notes receivable gave $900. So R. Brown paid his note on June 6th. So there it is. $900 was received as a promise. $900 merchandise was given. Cash was received, and the notes receivable was given. So there it is. Received, given, received, given. Merchandise for cash. So all these balance out. So the notes receivable, we saw here, the note was $900 issued, 10 days later paid. Merchandise, on that date the note was issued, he received, we gave for merchandise $900 credited. Note the final result is exactly equivalent to a cash sale. The value received for value given. The notes receivable account is a temporary account, serving the same role as a customer's personal account. Both disappear once the debt is settled. Wow. So temporary accounts. Think of that. Notes payable when we give our own note. So on June 15th, bought of S. Johnson on our 10-day note 50 barrels of flour. We received merchandise and gave a written promise to pay, and that goes into notes payable. So here's the account explanation. Merchandise received $600, and that came on notes payable. And that was bought on my 10-day notice. 50 barrels of flour. Then on 25th, notes payable, the $600 was received in the notes payable, and it came from cash. So the notes payable, when we had that credit in the notes payable, I gave a 10-day note to get that 50 barrels of flour. 10 days comes due, then we have to put that back into the notes payable account so it can get paid. $600 of that cash, paid my note favor of S. Johnson. When we pay the note, notes payable is debited. We receive back our written promise. Cash is credited. So the note comes back. We receive back our written promise. The test. Ask yourself, are we to pay this note at maturity? If yes, notes are payable. If no, it's notes receivable. So if you don't have to pay it at maturity, it's receivable. So we see on here how simple that is. The same thing. Balance equals we still owe. There's no balance here because we paid. A note that we call notes payable is notes receivable to the person whom we promised to pay, and vice versa. Notes receivable always has a debit balance. We are owed money. Notes payable always has a credit balance. We owe money. And once it's balanced, it disappears because it's temporary. So we're on to discounts on purchases, sales, and notes. 3 distinct kinds of discount, each a price for use of money earned or given at different times. Earned or given. So let's look at the discount on purchases earning a reward for early payment. So on August 1st, we bought American Woolen Company 150 yards of broadcloth. $1,500. Terms are 230 and 60. What does that mean? We'll get into that in a second. August 29th, we paid American Woolen Company cash in full of invoice of August 1st, less 2%. So the terms 230 or N60. So 230 means 2% discount to pay within 30 days, and the full amount is due within 60. If it was 260 and 90, it means 2% discount if paid within 60 days and full amount due within 90. So we did the 230 and 60. So this is the terms we did for this one here. On August 1st, we received $1,500 of merchandise from American Woolen. That was the 150 yards we bought of broadcloth. And we have here the terms, the 230 and 60. So if we pay within 30 days, which we did, we paid on the 29th, then there's a discount. So there's that discount calculated as $30. So cash, $1,470 came out of cash, and the $30 on discount we gave to the American Woolen account. So you see here, this $30 didn't come from our cash. The cash was $1,470. The $30 came from that discount. So discount purchases appears on the credit side. It is a profit to the business. We used our money 30 days early and earned $30 for doing so. Rule: credit balance equals profit. So when we see credit, we see extra stuff in the credit column, that's profit. Discount on sales. Or I should say, hang on, what would they say here? I don't want to. Oops. Oh, Lord. Let's see here. Discount purchases appears on the credit side. It is a profit for the business. Discount on purchases. So when we have this here, this is an American Woolen Company. They received 1,500, but it only came from 1,470 of our cash account. The discount on purchases gave the other 30. So being that didn't have to come from our cash, then that becomes profit. And discount on sales, giving customers an incentive to pay early. So we also sell goods to customers, giving them the privilege of paying early and deducting a discount. Suppose we sold Franklin Lyon on August 5th, goods invoice at $2,000, terms 230 and 60, and he paid on August 15th. So August 5th, he has 30 days to get that 2% discount, and he did. So he gets $40 of a discount. So that means that this is an incentive. So we sell goods and we give them a discount. So think about this. This is what operating at a loss now. Cash debited only $1,960. Discount on sales debited $40. Franklin Lyon's account closed at $2,000. So the discount on sales versus discount on purchases. Direct comparison. Discount on purchases, normal balance will be on the credit right side. The effect on business, profit. We saved money. So the normal balance will be on the credit side. Who gains? Us, the buyer. The discount on sales, the debit left side is where the normal balance. Effect on business is loss. We received loss. See, this is the debit left side for the discount on a sale. This discount here is on the left side. And the customer, the buyer, is the one who gains. Well, I mean, it's an incentive to do business with us, so I guess it's a win-win, right? Then we have discount on notes, converting a note to cash at the bank. And this is all before the Emergency Banking Act in 1933, getting ready for that. The wartime, this is after World War I, the depressions around the bend, that's where the world was at this point. We may sell promissory notes to the bank, discounting them. So this is interesting here, the discount. We still see these terms too, especially in dealing with the Federal Reserve. On April 4th, we received a 60-day note. On April 16th, we discounted it at 6%. The bank pays face value less 48 days interest. We debited discount on notes for the cost. So let's look at this here. April 16th, cash received 988. Okay, we may sell promissory notes to the bank, discounting them. So we received 988 and a discount on the note was $12. Notes receivable is a full 1,000. So you see here, because the full amount is on the credit side, we discounted R. Brown's note 48 days at 6%. So we received 988 in cash, but gave up a $1,000 note. The $12 difference is discount on notes, but at a cost. So we sold this note to the bank, and we discounted it at 6%. So we could get that cash now, 988 minus that discount, because we sold that note. The touchstone is the expense account. Expense is a loss and always has a debit balance. Accounts like discount on sales and discount on notes have debit balances. They are losses. accounts like discount on purchases have credit balances. They are profits. Discounts on purchases are profits. So when we earn the discounts, if we give cash for notes at a discount that we can later recover as a claim, then that would be a profit. So let's look at the account. Discount on purchases. The nature is profit. It's a reward for paying early. The balance beyond the credit, and the touchstone is like an opposite of an expense. So it's like a discount on a purchase is less of an expense. Discount on sales is a loss, cost of attracting prompt payers. And the balance would be on the debit side and like expense account. And same with discount on notes. Loss, converting notes to cash. Balance will be on the debit side and it's like an expense account. So I hope this is getting clear here now. You see the way notes are converted. So now let's look at another one here, return of merchandise. Goods sometimes come back. 4 scenarios, cash returns and credit memorandum returns, both buying and selling. Oh, Lord. Salute to all you that are still here. And let's see here. Chat should still be functioning good and with the talking back feature. So if you have any questions, clarifications, any additions to make here, we want to keep it interactive, and the special surprise is coming right up. So let's look when goods are returned. The original transaction must be partially reversed. The motion picture shows what is given and what is received in each case. We have 4 cases here. 1, we return the goods we bought for cash. So cash received back, we debit cash. Merchandise given back, we credit merchandise. So we get cash back, we return some rotten apples, we get debited cash. When merchandise is given back, we are credited merchandise. So they bring back something that they didn't want, it goes back into our merchandise, or they gave merchandise is given back. So the entry here is cash, debit, merchandise, credit. So cash received back, we debit the cash. We return goods we bought for cash. The merchandise is given back, so we gave our merchandise back. And we got our cash back. So that should reverse that. Now case 2, we return goods bought on account and we receive credit memo. So the creditor's claim against us is reduced. Debit John Brown, the creditor account. The merchandise is given back, so we credit the merchandise account. So we return goods that were bought on the account. Merchandise given back, we have to credit the merchandise. We gave back our goods, and then the creditor's claim against us is reduced. So on the entry for John Brown, which was the creditor here, we give the debit. Now, case 3 is customer returns cash sale goods. The merchandise received back, so we debit merchandise, receive back to merchandise, and the cash is refunded. So we gotta give him cash. That means we give cash. Cash account is credited. So we credit cash to that customer. So the entry, merchandise is a debit, cash is a credit. And finally, case 4, customer returns on account goods. We issue a credit memo. So the merchandise is received back. We debit the merchandise. The customer's debt to us is reduced, so we credit FF Pierce, the customer account. So entry here, merchandise, we debit, and the FF Pierce account, we credit. So that account gave back. The customer returns on account goods. So we have to give credit. We issue the credit memo. All right, we're on to the division of merchandise account. A single merchandise account becomes unwieldy. Accountants advocate 3 separate accounts for clarity. So we're getting more into the modern methods here. For those of you still with me, this will get real familiar now because we've seen this, the old system versus the new system, and why we divide merchandise. In the old system, One merchandise account holds purchases, returns, sales, and return sales mixed together. The new system replaces it with 3 separate accounts. The old system was one account. The debit side contains opening inventory, all purchases, and return sales, and the credit side contains all sales and return purchases. The new system has 3 accounts. We have merchandise inventory, purchases, and sales. So the opening value of goods on hand is the merchandise inventory. Purchases, debits are all purchases, the credits are return purchases. So we receive all purchases and we give back all our return purchases, and then there's the sales we make. We credit all sales, we give our sales, and we, of course, debit the return sales. We receive our return sales. With all 3 account system, total purchases are visible on the purchases debit side, returns on the credit side. The sales account shows total sales on the credit side and return sales on the debit side. It was the 3 account system. So here we see the account explanation. On this column here in the date, again, we have our ledger folio numbers. So the purchases, Brown Flander on a 30-day note, he bought 100, bought 100 barrels of flour and BU corn, and a bushels of corn. All right, so there we go. And he paid, so the purchases, we bought $2,400 worth. So we received $2,400 of purchases, not just merchandise, we call it purchases here, and $2,400 is on a 30-day note. That's what we gave to Brown Flanders. Then on April 14th, Marcy Brothers received $320. That was, they received $320, and that's a sale sold on account. 3 barrels of flour and 2 barrels of apples. So those are the sales that we made, and then we received $320 as a debit from Marcy Brothers, and I would assume this would be cash because I don't see note. Oh, sold on account. No, so it was onto their account. There it is. So both these are on accounts. This is sold on account. This is bought on account, and you can see how it pans out here. On both these, we received purchases. On this one here, Marcy Brothers, they received $300 onto the account when we sold, and then the credit of on sales there is what we gave up. Sold on account, 3 barrels of flour. So we sold on account. Here we bought on a 30-day note. Getting complicated yet? Let's get to inventories. Unsold goods at period end represent assets. So the period is what represents assets, period. Their cost must be deducted to find the true cost of what was sold, as I alluded to towards the beginning of the presentation. Calculating cost of goods sold, the inventory formula. At period end, we count and value all unsold goods. This is the inventory. It is deducted from total goods available to find the true cost of goods sold. So the cost of goods sold formula. Merchandise on hand at the beginning, 1,000. Add net purchases, purchases less returns, 3,500. So that's the total goods available for sale, 4,500, less inventory of unsold goods at end, 800. So here's the total cost of goods is 3,700. So here's where we started, and here's where we ended. So the inventory formula is beginning plus purchases minus returns minus ending equals cost sold. The inventory is ascertained by obtaining the quantity of goods on hand and valuing them at cost price, unless the market price is lower, in which case the lower price is used. That's called the conservatism principle. That's nice. So the inventory is ascertained by obtaining the quantity of goods and valuing them at cost price. The expense inventory, just as we have a merchandise inventory, we have an expense inventory. Example given here is stationery, still unused. Coal, not yet burned. So unburned coal or fuel, I guess. The actual loss from expense account is total charge to expense, unconsumed items remaining. As you see now, like if you have gas going to a business instead of coal and it's metered, it's not being stored, so it's not in inventory. Very interesting the way things have changed over the years. Every trial balance account with a debit balance represents either an asset or a loss. Inventory items are assets. They appear in both the profit and loss statement, where they reduce cost, and the statement of assets and liabilities, where they appear as owned property. Ooh, getting really complex here and blurring into our property stuff, but now we're on to the progress of the business. The profit and loss statement reveals whether the business is being profitably conducted. So here's our profit and loss statement of H. Guther, May 1919. So here's H. Guther's complete profit and loss statement for May 1919. Profit and loss statement, merchandise. So you can see here how this goes here. The cost of merchandise sold here on the right, the proceeds, $5,200 of net sales on the debit side, profit on the merchandise carried down. Notice that the items in red, full profit and loss, $1,000 opening, plus $3,500 in purchases equals $4,500 in goods available. So this is the opening here. Anyways, let's look at this two sections here. We have the merchandise and we have the expense and discounts. The merchandise section compares cost of goods sold to sales proceeds to find your gross profit. So that's where we get our gross profit from. So we have our profit, our gross profit, and then our net profit here. Net profit equals gross profit on merchandise minus expenses, plus discount on purchases, minus discount on sales, minus discount on notes. We went over all those. We see where each column, each of those discounts belongs. So here's our three formulas. I'm not going to reiterate these formulas, but you can see how simple these formulas really are. This is not complicated math. It's definitely not rocket surgery, and you don't need to be any kind of a brain scientist to be able to figure this stuff out. So let's get to the condition of the business. The statement of assets and liabilities shows what the business owns and what it owes and what it's worth. So here's a statement of liabilities. Condition of a business shows its present or net capital. All assets listed against liabilities. And I'm not going to go over this totally here, but we can see the total assets is $4,100. The total liabilities is $1,100. So our net capital, our present worth is $3,100. Very simple arithmetic here. There's three critical observations from the statement. Every trial balance account with a debit balance is either an asset or a loss. If it is cashable, it is an asset. Otherwise, it's a loss. Every trial balance account with a credit balance is either a liability or a profit. If the business must pay it, it's a liability. Otherwise, it's a profit. Those are those discounts. Okay. Every account appears in either the statement of assets and liabilities or in the profit and loss statement. Every account appears in either, but not in both. Exception. Inventory items appear in both. Wow. You see how this is all coming together? It's a lot simpler than one might think, and you might have to look at this a few times to really get it down solid. But this is where it all starts to come together in the modern accounting. And we get to balancing accounts now. Before closing the books, all accounts must be formally balanced. Their balance is brought to a permanent record. So let's look at the 7 steps. When the books are closed, it's sometimes desired to show balances in a permanent form. Here, the 7 steps apply to cash account. So remember, the balance balances equal balance balances, so you don't need to balance everything. So 1, foot up both sides of the account in pencil, making small figures closest to the item here. Compute the balance in pencil on the. All right, so this is all done digitally today, but you can see here the way it's done here. Bring the balance down in black ink and opposite under the date of the new period. This becomes the opening balance for the next period. So let's just look at what we got here. On the debit side, the credit side here for the cash account, formally balanced, we have the 5,000 from Luke that we received. That was the proprietor. Then sales of 800 and sales of 600. These are all received. Total 6,400. And then over here, we have the rent paid 120, salaries of 200, merchandise of 900, and on June 30th, our balance is 5180. So all this together is 6,400. Those balance. But this 5180 is these balance out, or equal, I should say, but the balance carried down from the credits is down here to July 4th. So this carries over. So in a red ink item, balance brought down to July 1 as a period's opening balance. So this is where we're at. And closing the books. Annually, the progress and condition of the business is incorporated into the ledger by transferring account balances to loss and gain. Oh boy. And this is how you get valuation. So transferring the expense, loss to loss and gain. Closing the books consists essentially of transferring the profit or loss shown by the individual accounts to a summary account, the loss and gain account, and from there to the proprietor's account, because remember, he didn't get that money for nothing. You need something back. First, transfer the expense account loss. So we have loss and gain here of $420. Expense gave $420. So there it is, a loss and gain in the expense. That's a transfer loss to loss and gain. Close the expense. And then the discount on purchases, $50. Loss and gain, $50. Transfer discount on purchase, profit and loss. So there it is. So our discount on purchases, this goes over, of course, it's going to be a profit. I'm sorry, yeah, it's our purchase, yeah, to profit. All right, losses go to the debit side, and loss and gain, losses and debits. Profit go to the credit side of loss and gain, profits are credits. The rule is consistent. Receive a loss equals debit. Give a profit to LNG, the credit the LNG. So the losses and debts, the loss and gain account. As you see here, profits go to the credit side. And again, the debits are the losses. So here's our loss and gain account. Here's our debits, and here's our credits. Here's our expense losses of 420 that we saw here. The loss and gain of 420 was from expenses. Here's the discount on sales, a loss of 30, and discount on notes, loss of 12. But the credits, we did merchandise profit, 1,500, and discount on purchases, which is going to be a profit of 50. So you see how all this comes in. This is now on a loss and gain account. All this we transferred. And closing the merchandise inventory, purchases, and sales. Closing of merchandise accounts requires 4 journal entries executed in sequence. Each entry moves the balance closer to a final profit figure that can be transferred to loss and gain. So here we go. I'm not going to go through this whole thing, but you can see here entry 1 transferred old inventory purchases, moved merchandise inventory. Again, we can see here where all these things were put here as an entry 2, entry 3, entry 4. Okay, after entry 2, purchases show cost of goods sold. After entry 3, sale is closed. After entry 4, the loss and gains receives the merchandise profit. And transferring net profit to the proprietor's account. Finally, after all accounts have been transferred to loss and gain, the net profit is transferred to the proprietor's account, adjusting his net investment to its current value. So loss and gain, the Buckley now is a proprietor here. So transfer net profit to his account, close the loss and gains. So loss and gains, they received the 1080. Then the proprietor gave the 1080 here, and that was transferred. So let's look how this goes here for the proprietor. Withdrawals, he got 700 and personal 200, and then credit the original investment. He gave 5,000, additional investment 2,000, and net profit 1,088. This is all part of his account. He doesn't receive this. It's just part of the obligation the business has, the claim he has against the business. So loss and gains, there it is all there. Net capital, this equals assets minus liabilities, confirming the books are correct. So you see the formula, very simple arithmetic. I'm not going to belabor you by reading it. Now we get to miscellaneous accounts, because as a business grows, single accounts are divided into specialized ones. The debit and credit method scales without changing its underlying logic. So let's see how it can scale up for multiple accounts. So the expense account, useful enough in elementary work, becomes too broad when a business grows. The bookkeeper then divides it into specialized accounts, each recording one class of operating costs. This is how we see modern accounting done. Similarly, cash may be divided by branch or department. The principle is always the same. Debit what the business receives, credit what it gives. So here's some expense accounts in the elementary system. We saw the rent paid, wages, postage, stationery, advertising costs, premiums, freight, taxes, telephone, and telegraph. But now we have specialized accounts in more advanced systems. So rent account, only rent payments. Salary account, wages and salaries. Advertising, all promotional costs. Freight account, in freight and out freight. Insurance account, premiums paid. And taxes account, all levies and licenses. So in this one, each account tells its own story at a glance. No analysis of a combined total is needed. And we have drafts, consignments, and other business instruments. So beyond promissory notes, also introduce some commercial instruments that appear in real businesses. Each follows the same credit-debit logic. Only the name of the account changes. So we have drafts receivable. It's a written order to pay. We hold it. Debit when we receive the draft from a customer, and credit when we collect the draft at maturity. So it's a written order to pay. We hold it. So when we receive the draft, we debit it, and we credit when we collect the draft at maturity. Draft payable, that's a written order to pay. Again, we must honor it. So we do a check or so. We pay the draft at maturity. A creditor draws on us, we accept. Consignment in, goods sent to us to sell on behalf of another. It's debited when we receive the goods. So we receive the goods, credited into the consignment account, and credited when we sell or return the goods. So consignment out, same thing. Goods we send to an agent to sell for us, and debited when we dispatch goods to the consignee. And then agent remits proceeds to us, then it's credited. So every specialized account, however named, obeys the same rule. Debit the account that receives, credit the account that gives. This method is universal. So again, like consignment in, there are goods sent to us to sell on behalf of another. So when we receive the goods, that's debited into the consignment account. But when we sell the goods or return them, then we gave them. Then would it have to be balanced somewhere else? We would get cash or a note, however it may have been. But you can see how each of these things could be paid with a draft, and we got to wait till the draft matures, etc. There might be discounts involved in other things. So the complexity of the whole financial system is right here in this complete arc of bookkeeping. Cash accounts, the double entry. Every transaction has two equal sides. Every debit has an equal credit. And personal accounts, the customers carry debit balances they owe us. Creditors carry credit balances we owe them. So remember, it's all about two equal sides, equal balancing. So when there's a balance due, then that tells us who owes who. Journal and posting, original entry in the journal, transfer to ledger accounting via posting. Notes receivable or others owe us. Notes payable, we owe others. So those are checks we write. And then discounts. Discount on purchases. Profit equals profit. Discount on purchases equals profit. Discount on sales and notes is a loss. And the statements, the profit and loss shows progress. Balance sheet shows condition, the net capital. Closing, transfer losses and profits to loss and gain. Net results go to the proprietor. So that's the profits and loss. Losses and profits go to loss and gain. And the miscellaneous accounts, specialized accounts to scale the method. So we have drafts, consignments, but they all apply the same rules. All right. Business, as is popularly understood, comprises the commercial activities of the community. Bookkeeping consists of the recording of the financial doings or acts of businessmen. These acts are known as transactions. All right, and that takes us to the best part for those of you who made it this far, and we take the fun quiz to test your knowledge. So here's how we play this game. In the chat, you put the number of the question you're answering, followed by the letter of your answer. So if this one I was doing for question 1, if I wanted to answer D, I would put it in the chat, Arabic number 1, followed by the letter D delta, and that would be my answer. If I choose to change it, I would just put in the same question number again, followed by my chosen answer, and that would be the final answer. We'll tally up at the end and test your knowledge. Let's get started. So question 1. Your business buys stationery and postage stamps for cash. Which accounts do you record this in? A, the debit merchandise, credit cash, goods receive. B, debit expense, credit cash, consumed items are expenses. Is it C, debit the cash, credit the expense? Cash was involved first. Or is it D, debit proprietors, credit cash, the owner authorized it? All right, so you got 4 choices here. This one should be very easy and straightforward. So anyone want to take a stab at question 1? Is it when you buy stationery and postage stamps for cash, do you debit merchandise and credit cash? Do you debit expense and credit cash? Do you debit crash?
Joseph figure 5227 says 1B.
All right, we got 1B. Anyone else wants to take a stab at question 1? All right, Joseph has 1B. We're going to move on to question 2. You sold merchandise on account to T. Brown for $500. No cash change.
Devin Aradaz says 1, capital B.
Excellent. So we got 2 for 1B. All right, so you sold merchandise on account to T. Brown for $500. No cash changed hands. What is the correct journal entry? Well, you sold the merchandise, so what is it? A, debit cash $500, credit T. Brown $500. Is it B, debit merchandise $500, credit T. Brown $500? Is it C, debit T. Brown $500, credit merchandise $500? Or is it debit T. Brown $500 and credit cash $500? This one should be pretty straightforward as well. I'm trying to keep these questions kind of simple because this has been quite the lengthy topic. So anyone want to take a stab at question 2? You sold to T. Brown on account for $500. So no cash change hands. So what's the correct journal entry you would do? Would you debit cash and credit T. Brown? Would you debit merchandise and credit T Brown? Would you debit T Brown and credit merchandise, or debit T Brown and credit cash? So think about it. It's to his account, so it's probably not to cash. Did he receive? Did he give? Who gave? Who received? Think about the motion picture analogy. You sold merchandise. You gave merchandise to the account. The account received. And the value for all this transaction is 500 on each side. So which would it be? Is it A, B, C, or D? Any takers? Going once, going twice. On to question 3. Your trial balance balances perfectly.
Joseph figure 5,227 says to be.
2B. All right. So we have a B on 2. Let me just double check on here so we can be sure what we're looking at. So you would debit the merchandise 500 and credit.
Debit says 2C.
All right. And we get a 2C. That's debit the T Brown. He received 500 and credit merchandise. You gave 500. All right. Pretty good there. Let's move along to the question 3. So your trial balances perfectly. Can you be certain there's no errors just because you got a perfect balance? A, yes. Equal totals guarantee every entry is correct. B, yes, but only if all journal entries were posted. C, no. Posting to the wrong account or omitting a transaction go in undetected. Or is it D, no, but only if there are more than 5 accounts? All right, so what's the correct answer? Your trial balance balances perfectly, but are you certain there's no errors? Is it yes, because equal totals guarantee every entry is correct? Or is it B, yes, but only if all journal entries were posted? So, or is it C, no, posting to the wrong account or omitting a transaction could go undetected? Or D, no, but only if there are more than 5 accounts. So, can you be certain, yes or no? And if so, which one? Again, this is just checking those trial balances, making sure those accounts balance out. But can you be certain there are no errors? And I think that's the hint. It's not necessarily just the numbers. Are we putting things in the right place is the real question. But we're going to get ready for the last question. So going once, going twice, going 3 times. We're on to question 4. At year end, net profit of $1,500 sits in the loss and gains account. Where does it go next? So we're not in profit and loss, we're in loss and gain. Where does it go next? A, it stays in loss and gain for future years. B, it is transferred to the cash account. C, it is transferred to the proprietor's capital account. Or D, it is split between expense and merchandise. All right, this is an easy one on question 4, year end. Net profit of $1,500 sitting in that loss and gains account. Where does it go next? Because it can't sit there. Well, it says here it stays there for future years. So if that's what you pick, that'd be answer A. But is it transferred to the cash account? Is it transferred to the proprietor's capital account? Or is it split between expense and merchandise accounts? Any takers on this? Question 4. We're going to get to the answer slide now. All right, let's look at our answer key. So question 1, the stationaries and stands for cash, which accounts? Well, it's B. Debit the expense.
Debit says 4, capital B.
All right, we had 4B. We got some lag going tonight, I believe. Let's go back here to, so 4B is transferred to the cash account. 15 is in the loss and gains. All right, let's move along here. Okay, so question 1. Stamps and stationery for cash, which accounts? Well, you debit the expense because you received things into the expense account. These are consumables, and you'll credit the cash. So the correct answer is B. Consumed items are expenses. Goods consumed by the business, not resold, are expenses, not merchandise. All right, and I think for question 1, we all get that one right. Indeed. All right, so we're on to question 2. Sold on account to T. Brown for $500. What's the correct entry? Well, we're going to debit T. Brown $500. He received it in his account. And we're going to credit our merchandise $500 because we gave $500 in merchandise. Business gave goods. We got to credit merchandise. It received a claim against Brown, and that's a debit to his account. So question 2, correct answer was C. Yeah, I believe we get that one right too. Excellent. All right, let's move on to 3, the trial balances. Definitely no errors. I don't think anyone took a stab at this. No, because posting the wrong account or omitting a transaction can go undetected. A balanced trial balance proves arithmetic equality, not that the entries went to the right accounts. So it's only one part, as we saw there before, and that's why we need to have the full explanation in the ledger there or the journal that refers to everything so we can be sure transactions go in the right accounts. Or entries, I should say. All right, takes us to question 4. Net profit and the loss and gain. Where does it go? Remember, after we transferred to the loss and gain, it's transferred to the proprietor's capital account. The closing entries absorb net profit into the owner's capital, completing the cycle. So there it is. That's how it works in accounting and why a proprietor would get into this mess to begin with. And the way you can keep the books. Think about it. If you invested in a business, wouldn't you want to be able to look at any point to see the condition of your business, whether you're operating at a profit or a loss, and what the value of your assets are? I think any prudent business person would. And that is the purpose of having this type of bookkeeping, the dual entry bookkeeping. So what seems like a very complex structure really isn't if we come down to the basics. So I hope that this presentation really set it home for everybody to understand the basics of the double entry bookkeeping system and how it's used in every facet of finances today. And it also behooves us to understand the way it functions so we can better manage our own finances, because in the end, everything ends up on the books and with paper. So thank you all for being here and taking this trip back in time to learn about the elementary accounting as it began in the last century with some of the historical information and with the new advanced techniques. And this is just the elementary overview of the essentials. And there's
Joseph
far more.
Figure 5227 says much love from Louisiana. God bless you all and your families.
Well, thank you very much, and blessings to you too and your families and everyone that's here. Salute to you all for being here and to participate in something. I know it's quite a dry topic. I'm really I'm honored to have this many people here to be here in a live stream like this on such a topic, especially right around tax season. But again, this is the way that we're ensuring that every dollar goes accounted for. And again, it also means that we're able to hold those that owe us any kind of thing accountable. And that is essential to know accounting if you plan to hold people accountable and yourself. So that said, thank you all for being here, and I hope to see you all on the next one. Peace out.